Howard Ward. He's the head of equities for Gabelli & Company. Let me first ask you, Howard, what you thought about the statement today. It seemed all calm, all as expected, until the substantial downside headline crossed.
Yeah, the big 6 words about the significant downside risk to the economic outlook. That was the killer. I mean, that's what sent the market down. Nobody was really expecting that strong language from the Fed regarding the economic outlook. So we do worry about that. Now, if there's a silver lining there, Matt, it's knowing that the Fed's own economic forecasts have been so terribly off the mark.
They're a contrarian indicator.
Maybe it's a contrarian indicator.
If they say it's awful, maybe it'll get better.
It was just in early August that they were talking pretty strongly and positively about the economic outlook, and here we are in late September, and all of a sudden, significant downside risk.
It has affected the market significantly. We continue to make new lows. Right now, down 271 points on the Dow Jones Industrial Average. It used to be that there was some kind of perverse logic. When the Fed was really gloomy, you thought, cool, they're going to give us some free money next. Does that not happen anymore?
Fed is, Bernanke's not a miracle worker. He's done a lot. Unfortunately, we spent many years building up all the debt that we have, and we're going to spend a lot of time deleveraging now. So the Fed's sort of pushing on a string. The money's out there, it's available. Operation Twist, we might get some incremental borrowing out of that, but at the same time, it's not a bank-friendly move. It's going to flatten the yield curve. It's going to reduce the net interest margin for the banks. So it doesn't make life any easier for the banks. It doesn't provide them an incentive to lend, really, even though they might have more people wanting to borrow.
The deleveraging and the time it's going to take, you typically don't hear a head of equities talk like that because that's not good for business, right?
Well, yes and no. Interest rates are now at a record low. The 10 years at a record low today. Stock market is yielding more than the fixed income market. That's extremely unusual. For a patient investor,
not as safe though, right? There's a lot more risk in stocks.
Less risk if you're taking a longer investment horizon. The CPI right now is 3.8%. Buying a 10-year Treasury at 1.9% gives you a negative real yield. I would rather take my chances in some very high-quality blue chip stocks, consumer staples with 3 to 4% dividend yields, for example, or utilities. I would much rather take that income up front, knowing that down the road I'm going to get paid on my capital as well. Buying bonds right now, this has been a 40-year bull market in bonds. It's very difficult to call the exact bottom in yields, but boy, we're close. We are bumping along the bottom.
Yeah, not much further lower that we can go at this point. I want to get the view from the trading floor right now. John Brady is the senior vice president at MF Global. He joins us from the CME Group out in Chicago. John, help make some sense of what happened in about the last half hour of trading or so. We saw equities really slide. Mark Grant of Southwest Securities saying maybe it has something to do with the S&P downgrade of 7 Italian banks. You also got maybe some disappointment over the Fed's newest plans. What's your take? What are traders saying that why we saw the sell-off here?
Well, there are a couple things, Julie. First and foremost, right behind me in the S&P futures pit, volume and crowd activity really picked up on the close here. So there was very strong selling into the 4 p.m. Eastern bell, and look for that to continue perhaps in the overnight. I think the markets are likewise jittery, not just on what the Fed did. They were pretty aggressive with the $400 billion number, and the wording of their statement did suggest growing concern about the near-term economic outlook. But likewise, too, we are picking up reports that GDP forecasts over in Italy are being downgraded to 0.7% from plus 1.1%. So the whole European situation seems to be taking another turn for the worse. So it's a combination of things, I think, that have led to heavy and loud selling on the close of today's S&P futures trade.
Sorry, I thought Matt was going to jump in. I mean, hey, John, let me ask you, though, as long as that European situation is out there, and this is not something that's going to go away anytime soon, I mean, we're going to continue to see pressure on our markets, aren't we?
No, we definitely will. And then the spillover, of course, comes through the financial sector, which you referenced just a few moments ago. The flattening Treasury curve certainly has a nefarious effect on net interest income, net interest margin. Banks remain hesitant to lend, specifically out of their real estate portfolios, Julie. And if Europe, if there's an intensification of banking problems in Europe, given the fragile nature of the U.S. economy and U.S. consumer confidence, a shock from Europe will, of course, have perhaps negative effects once again on U.S. markets.
And, John, I'm going to echo the point on volume. We hear little beeps out of these traders' handhelds, and earlier today there was not a peep. Now, as we approach the close, it's like a symphony of crickets down here. And I want to also ask my guest here, Howard Ward, about your comments on Europe. It is so key. It seems to weigh so heavily on the markets. You could see downgrades from Moody's of 3 banks here in the U.S. and nada. Downgrades of Italian banks from S&P, and all of a sudden we're down another 150 points. Is Europe that important?
Europe is very important because, again, it's the banks, the fear of a contagion through the banking system that would spill over into the United States. The European situation has been dragging on now for how long? And
longer than we've been saying Operation Twist, which seems like forever to me.
If they really had the political will to put it to rest, they would, but they haven't. And they keep basically kicking the can down the road. They're probably going to give Greece the 8 billion euros to continue for another quarter, and then what? So, you really need to do something there to recapitalize those banks. The sooner the better, of course, and I'm not the first person to suggest that.
Are you an optimist, though? I mean, do you think they will?
I think a good crisis is going to get them to do that, yes, because I think the alternative is to be avoided at all costs.
John Brady, what are you hearing from guys there in Chicago? Do you think that the bond vigilantes are going to come out and punish Europe? That's why they're not here in the U.S.?
No, I think, Matt, I think that the trade to watch is 5-year CDS on Germany. It's up about 19% in the first 4 trading days of this week, Friday last week, and then, of course, the first 3 days of this week. So it's really German CDS that is going to start to make the markets nervous. Keep an eye on it. That's right, on German 5-year CDS. That's right. So you're starting to see the stress feed out of Spain and Italy into Germany. And, of course, Germany being the financial bulwark of Europe is going to make traders rather nervous. Likewise, too, I think I may have referenced Julie earlier. Carol, I'm sorry. I please forgive me. I called you by the wrong name. I'm sorry.
It's a compliment, so you can call me Julie anytime.
Oh, Carol, I'm sorry.
No. Hey, listen, I want to bring in some other headlines, guys, that are crossing, because we've been watching the trade today. The equity market certainly sold off. Goldman Sachs, in particular, closing below $100 for the first time since 2009, and that's a stock that's down about 42% so far this year. So just endemic of some of the concerns that are out there and the worries about financials specifically. We've talked a lot about what's going on in the equity trade, the gold trade, the Treasury trade. I want to get to copper. Adam, you've been watching what's going on with copper today.
Well, Carol, what you have here is a total breakdown on copper. If you take a look, I'm showing you a year-to-date chart of copper, and we have really broken all the way through. That's the issue. This thing is now, you're seeing it trade at about $3.69 a pound. Call 370 or $3.70 a pound. It's kind of funky the way they code it here on the charts. But bottom line, that is a breakdown. So the concern is whether or not you can actually have some sort of global rally if the markets are telling you that the industrial metal that is consumed by the emerging markets is frankly breaking down the demand, just not there. Yesterday, we saw the IMF lower its global growth forecast, Carol.
All right. Hey, while we're talking about things, let me also go to Julie, who I've been called a lot to in this last couple of minutes, but that's good. Hey, Julie, let's talk about HP, because this is one stock that's actually bucking the trend today, big time.
It is bucking the trend, but I mean, when you look at today's move in Hewlett-Packard, it's really just a blip on the longer-term chart. We've been talking about that since Leo Apotheker took over as CEO last November, the shares are down more than 40%, and today's 7% rise doesn't put much of a sort of a chink in that overall decline. There's still a lot of questions about what happens next at HP. Is Apotheker, in fact, out? As our reporting has discovered, the board is considering. Will the PC business still be spun off? Will the autonomy deal stand? It looks like legally it will have to go forward. But what does HP do to sort of pull itself out of this downward spiral? Howard, I want to ask you about it, actually. I know you're not a shareholder of HP per se, but when you look at a situation like this, I talked to a lot of people today who said Hewlett-Packard, for all of its troubles, is cheap. When you look at some of the tech stocks, some of the older line tech stocks, are you seeing any opportunities there because of the valuations?
Well, I think Hewlett-Packard is cheap for a reason. This is a company that's been confused about what it wants to do for quite some time. If you go back just 10 or 11 years ago, they bought Compaq because they wanted to be the big force in personal computers. They bought 3Com because they wanted to be bigger in consumer and communication electronics. They bought Palm because they wanted to get into smartphones. They took their old scientific instrument business and packaged it and sold it off as Agilent because they wanted to get out of that business. Then they bought EDS because they wanted to get bigger in services. It's like one of these days they got to decide for good what it is they want to be and stick to it. And right now the plan, getting out of PCs, buying autonomy, very radical plan, maybe done a little bit too, without enough thought. And so I think it's a mess, and I think there's a real leadership vacuum at Hewlett-Packard, and I wouldn't be surprised if they have a new CEO within the week.
You put it that way, it is really unbelievable going through those points. You do like tech stocks, though. I see on your list of picks here, Apple, Google, Qualcomm, Microsoft. Are you concerned that we didn't see the cycle of replenishing? We didn't see people go back in, especially business spending, pick up?
Well, I think that a couple of things. We've had a lot of bad news since the August 8th low on the S&P. The market's still about 4% above that 1119 low on the S&P that we hit on August 8th, despite all the bad news. People have been buying stocks, and the stock market is a leading indicator. It will look over some economic weakness. It will look over a recession as long as it's shallow. So I don't think you write off stocks. I do think you look at good earnings like we saw with Oracle, like we saw with Adobe's good outlook. We're going to see great earnings out of Apple and Google. There's a real earnings, secular growth story there with technology, and I think you stick with it.
Got it. All right, Howard, thanks so much for joining us. Howard Ward here from Gabelli & Company. John Brady, thank you as well.